Hello and welcome to Financial Intelligence. In this video, I want to talk about SPACs, which have become one of Wall Street's hottest trends. This trend has been so lucrative that celebrities from sports heroes like Shaquille O'Neal to music icons like Jay-Z have been increasingly lending their names to SPACs. O'Neal is a board member of a fitness-oriented SPAC, while Jay-Z sponsors a SPAC which is focused on cannabis. A special purpose acquisition company, or SPAC for short, is essentially a shell company set up by its sponsors with the sole purpose of raising money through an IPO to eventually acquire another company. At the time of their IPOs, SPACs have no existing commercial business operations or even stated targets for acquisition. In other words, a SPAC makes no products and does not sell anything. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Usually a SPAC is created or sponsored by a team of institutional investors or Wall Street professionals from the world of private equity or hedge funds. These so-called sponsors provide the initial capital to form the SPAC, which is typically utilized to hire underwriters, auditors, counsel, and other advisors. It is also used to fund the SPAC's initial public offering roadshow and ongoing marketing/public relation operations to attract investors. Also known as blank check companies, SPACs have been around for decades. However, in recent years, they have become more popular. For instance, roughly 200 SPACs went public in 2020, raising about $64 billion in total funding, nearly as much as all last year's IPOs combined. Moral hazards lurk within SPAC structure and could create serious issues. These risks exist because of the inherent conflict of interest between the sponsors and the investors. Here are 3 moral hazards that can seriously impact SPAC investors. Moral hazard number 1: sponsors' compensation. The initial capital provided by the sponsors to create the SPAC generally represents 5 to 7% of the anticipated SPAC IPO gross proceeds. For example, if sponsors plan to raise $100 million in their IPO, their capital must be between $5 million and $7 million. However, sponsors typically receive 20% of the common equity in the SPAC after the IPO. Right off the bat, you can see that there is a huge financial incentive for SPAC sponsors to raise money and identify an acquisition target regardless of its potential return on investment. That is because they put in only 5 to 7% of the required initial investment, but they will end up owning about 20% of the shares after the IPO. SPACs are very compelling for Wall Street bankers as they are more financially lucrative than traditional private equity funds. Additionally, because the sponsors' special rights partially protect them from the downside of the IPO outcome, traditional SPAC structures have the potential to create a moral hazard problem and lead to conflict of interest between the sponsors and SPAC shareholders. Moral hazard number 2: time pressure to invest. A SPAC goes public without a business plan and its sole goal is to acquire another company. The SPAC sponsors will conduct due diligence on any number of privately held enterprises to find a candidate. But if they don't find one, the money must generally be returned within 2 years. In other words, SPACs have 2 years to complete an acquisition, or they must return their funds to investors. It isn't difficult to imagine that this restriction creates a huge conflict of interest between the sponsors and the investors. If sponsors are not going to get paid unless they invest the money, they're incentivized to find an acquisition target at any rate, even if it's not a great investment opportunity for the investors. Since an increasing number of SPACs chase a dwindling list of targets, sooner or later the incentive structure ensures that the number of bad bets by SPACs will increase. Moral hazard number 3: involvement of celebrities. With all the hot money created from stimulative monetary and fiscal policies, there is huge competition for a limited pool of target companies. The SPAC market has been so hot that it has attracted celebrities from sports heroes like Shaquille O'Neal to music icons like Jay-Z. Many people who follow these celebrities have been lured into these kind of risky investment vehicles. However, many retail investors fail to understand that the involvement of these celebrities in SPACs does not mean that these investments are going to be profitable. Celebrities, like anyone else, can be lured into participating in a risky investment. It is never a good idea to invest in a SPAC just because someone famous sponsors or invests in it or says it's a good investment. Additionally, some of these celebrities are just using their brand to attract more investors to their own SPACs. These celebrities are collaborating with Wall Street bankers to rob the suckers. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to subscribe, like this video, and hit the notification bell so that you won't miss any of my future videos. Thank you and take care.